Turbo Trading with head trader Robert Knight, MBA.
Okay, welcome to this webinar on how to stay mentally disciplined in our swing trades. First, the key issue that we want to talk about first is that we are technical analysts, and we're looking strictly at chart patterns to use for our swing trades, ideas and suggestions. Now, let's quickly look at here. This is the SPY. This is the ETF SPY. One thing about patterns is the ones that we look at. They're approximately 70% reliable. 70% of the time the chart's going to work, 30% they aren't. So it's that 30% that don't work that we need to cut the losses quickly, and the other 70% we either have a small gain or a big gain. Now we've been calling this SPY because it's been in this big uptrending channel until it broke down here. We went a bit negative on its pullback. But here on October 18th, I said, in my blog, I said, this is the start of the Santa Claus rally, and away it goes. And why did I say that? Well, it was in a downtrending channel, made a three-wave corrective down move, and then pulled back, held the support, off it went, the 20 crossed through the 50, and got in this big, strong rising channel. So these are the patterns that we're looking at that we use when we put on swing trades. And in this case, I was very bullish on it. 70% of the time this is going to work. And sure enough, off it went. It went up 9% from our entry level. But what is a chart pattern? I mean, how do we come to these patterns to recognize them? And you have to realize that the chart patterns themselves, at any second, any minute, whatever the case may be that you're charting, every time there's a trade takes place, a buy or a sell, a buy being that somebody goes up and takes it off the offer, and a sell being somebody hits the bid. Anytime, because there's obviously two sides to a trade, but anytime there's a trade, let's call it that, a point is generated on the chart, and those points accumulated together form the basis for the chart. The charts themselves, so then, are the sum total of all the knowledge of all the traders that are trading that particular stock or ETF or index at that particular time. Some may be watching it, some may have their orders in lower, some may have their sell orders in higher. Some may go in at the market, but it's the sum total of all the knowledge of all those traders, their opinion on what the stock's going to do. So we don't need to do fundamental analysis on these charts because the market has already done all the fundamental analysis. And therefore you get a trade, you get a buy and a sell. Then what happens is the technical analysts come in and they see a chart pattern. And they, depending on what chart pattern they use, they will buy or sell that stock. Now, and I've done videos before on all the different chart patterns. There's a lot of trend lines, support, resistance, VWAP, moving averages, RSI, MACD. Ichimuchi cloud or whatever it's called. I mean, there's cloud EMAs. There's lots of them out there that you can use. But there's two key things that you have to recognize, and this is all going to come in. And I'll get to how this plays into the mental discipline of swing trades. But this all comes into what's important is that whatever charting pattern that you're going to use, whichever technical analysis you're going to use, it has to be recognized by a lot of other people as a valid charting pattern, and B, you have to see what everybody else in the world is seeing. If you're not, and you say this looks like a good entry op, say you were looking here at, or 450 or as a sell, there's nothing, nobody else in the world sees 450 as a chart pattern. I shouldn't say nobody. Some people do. It's a round number, it's a whole number. It could be, provide resistance. But the rest of the world, they don't see anything like that, so they're not going to trade it. So you put in a trade to buy or sell at that level, it's only going to be luck that it is successful. And more times than not, you're not going to catch the 70% success rate, because you're not seeing what everybody else is seeing, or your charting proficiency is going to be different than everybody else. And so therefore, it's not really a signal that anybody else sees to buy or sell the stock. So that's a key point. So and that's sort of why we're here at Turbo Trading, to guide you through these trades that we do, so that you get to understand what the patterns are, because it's key that you see the patterns and trade those patterns. And so that's how we get into the mental discipline of the swing trades. We'll go through some of the swing trades that we've put on here just recently. We just put this on yesterday, BLNK. We're in this at 35, and we have a stop under 30. So the BLNK was in this descending wedge pattern, big declining tops line, popped up to it, pulled back, held the support on the 50-day moving average, and we see that the 50-day moving average is crossing through the 20-day moving average is crossing through the 50. Now let me go back one step. At Turbo Trading, we just use 3 technical indicators for charting. We use the support, resistance, and trend lines. That's all we use. As a backup, we keep an eye on the 15-day moving average, or the 15-period moving average, whether it's a day trade or a swing trade, and the 50-period moving average. So in this case, the 15-day and the 50-day. But we see it's crossed up through here, pulled back. It held the support on the 50, and it broke out through this declining tops line. So this was an indicator. This is a lagging indicator, but it did show that our idea is correct. So we put it on here at 34 when it broke out. And as luck would have it, it traded to 40.50 on that same day for a $6 move. Now, we had targets of 44 and 50. So I personally, I didn't take any myself, but here's the key point to this. When we put on a swing, we set targets, and the reason we set targets where we do is because that's where you're going to run into major resistance. So I said 44. That's up here, right here, at this level. It's actually 44.75. I don't know, 44.50. But a whole number is a key number for stocks. So I set it at 44. We didn't quite get there, and we get this big reversal. Huge spike. So this went too fast. So if you took this trade yourself, because ours is just guidance or just put in levels, you have to manage the trade yourself as you see fit, the best way you can. So when you get a huge move like this, and then a bit of a reversal, I wouldn't be disappointed if you took some of the profit on that sell-off when the markets came back and pulled back. I wouldn't, and then look to re-enter it. You can do that, and you can take those kind of trades. What we're normally would be looking at is a stock that's when we take these swings on, we're not trying to take stocks that are very volatile. In this case, it was very volatile, and it corrected very quickly. So you have to manage it yourself. But the key point to this is, let's take a look at another swing we have here. AEHR. We're in this at 7.25. It made a cup and handle pattern here, broke out through this level here, 675, pop, pulled back, and we entered the trade. and it gets into this big rising channel. And this is exactly the kind of trade that is much easier to stay in, much easier to trade. You get in a channel like this and you just ride it up. And we set targets at this AEHR. And basically, every time it got to the top of the channel, you sell a bit. When it got to the bottom of the channel, you could actually have added to it. We don't typically do that, but you can. And then it gets to the top of the channel, you let a little bit go out. So our next target for this is up here at 40. So how do we stay in this trade? Well, this is where the discipline comes in. You have this big rising channel line. You have the 15 period moving average, which it's at, but you also have the 50 down here, which is your key support. You'd want to stop it under this 17 level, which is the 50 moving and this lateral support. That's your because you don't want to get stopped out of this trade too soon. You need to be able to have the mental capacity and the wherewithal to weather pullbacks. Because if you don't weather the pullbacks, you're not going to make the big money. We're in this at 7.25. It traded up to 26. It popped up here. Now we have been selling all the way up. We've been letting a little bit go, which is key. But if you saw this pull back and you freaked out, here at say 13.5, and it held the trend line at 12, and you freaked out and left the trade behind and didn't get back into it, you left another 100% move in this trade. These patterns are 70% effective. So you stay in the trade as long as it meets your criteria, as long as it doesn't violate your chart pattern, you stay in it. Yes, there's going to be pullbacks, and yes, sometimes those pullbacks are going to be more dramatic. If this all of a sudden sold off, well, let me rephrase that. If this started to roll over and trade down, then we'd probably look to get out of the stock. We'll keep moving the stops up all the way. If it has a very sharp correction, a very sharp sell-off, then regardless of what our stop is, we just stop out. We just take the profit and run, because that is that ruins the chart. That ruins the pattern that we're trading. But as long as the pattern stays the way it should, then we need to stay in the trade. You'll never make any big money if you had bought this at 7.25 and put it on as a swing and sold it at 8, just because it was a little bit green, up 75 cents, 10%. Woohoo! And, instead you could have rode it for, 200%. So you can sell it all the way out, but as long as it meets your criteria, and that's the mental discipline. The mental discipline is to be able to recognize what the chart pattern is, where the resistance levels are, where the support levels are, and stay in the trade as long as it meets that criteria. And if it does, then you're going to make huge money on these things. The biggest one that we made a couple of years ago was Tandem. We put this trade on back in 2018 at $4, $3.98. And we rode this stock all the way to here, 53. From $4 to 53. This is a weekly chart, so it's, you can't, it's a little bit more difficult to see. But it stayed in this huge rising channel, and we just stayed in the trade. And, we made over 10 times our money on it. Pulled back, re-entered at 35, and we rode it up to 100. Why? Because it was in our pattern, it stayed in it, and we were able to, capitalize on it. So, just to reiterate, patterns are only 70% effective, but as long as the stock trades in your pattern, you need to stay in the trade and don't panic. You can't panic with these things. There's no emotion in trading. It is strictly follow the chart pattern and don't follow your gut.
Don't forget to like and subscribe to our channel.